The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Sentiment shifts, investors rotate, attention turns to that big U.S. jobs report. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. on this Thursday. A little bit of a rally on our hands if you look in the right places, namely the S&P 500 higher by about 0.5% right now, shaking off yesterday's performance. Can't exactly say the same when it comes to the NASDAQ 100. An interesting divergence there, not one you often see. The NASDAQ 100, big tech, down by about 0.2%. Take a look at oil as well, moving lower right now, down by about 2.6%. It feels like we've been in this price range for a while here, the mid-90s or so. And the bond market, a little bit of a rally, but I stress little because 10-year Treasury yields down by about 2 basis points, but the absolute level still around 4.5%, Romaine.
You know, Katie, if there was any day that you were actually going to finally single out the Dow Jones Industrial Average, today would have been it. Snicker all you want about the price weighting of the Dow, but it is the structure of that price rating that is precisely why the average is outperforming the rest of the market today. For the 5 biggest weightings rallying hard, led by a 6% intraday jump for United Health, a 5% intraday jump for Goldman. That's pushing the Dow to a record high, and get this, its biggest daily outperformance relative to the S&P and NASDAQ since January 27th, 2025. Meanwhile, the opposite effect is kind of underway with regards to the market cap weighting. That's keeping the NASDAQ contained as Micron, Qualcomm, and the other chip names get dragged down by Broadcom's less than bullish outlook yesterday. Broadcom's drop, which coincidentally is the worst since January 27th, 2025, is a reminder that always chasing that upside sometimes becomes the downside, particularly when AI spending is still running far a pace ahead of the AI business model. Now, it is that business model that is still in flux, but the AI impact that is real. Outplacement firm Challenger Gray saying AI now the leading reason companies are given for cutting jobs. It will be interesting to see if that's actually reflected in official data, like the U.S. government's monthly jobs report tomorrow, which most economists actually expect to show hiring in the leisure and hospitality industry, helping to keep the upward momentum in the employment rolls.
What I think of it is as, sure, it's possible that businesses are looking for cost savings and they hire fewer workers and they do just as much because they're using, an LLM assistant to help. But we just haven't heard from businesses that they're seeing transformative, ongoing productivity gains yet.
And that was San Francisco Fed President Mary Daly, Katie, sitting in front of the hedges there in San Francisco, which is, I'm told, still the seat of our technology economy.
Absolutely. I believe that still is the case. But it's interesting because, the conversation that we've been having about tomorrow's jobs print is that you do have hiring in this economy, but it's very narrow, similar to the stock market. But let's take a look at the data behind us to maybe put some meat to what we were saying about AI and layoffs, because we have 2 data sets here. In blue, you have the Challenger U.S. Tech jobs cuts, and then in white, you have the JOLTS job layoffs overall. And you can see that when it comes to economy-wide layoffs, that's in white. You really have to squint with this data because, it's kind of noisy, but you can see that overall those layoffs are falling. But then you take a look at this blue line, similar to what we were just saying here, that you can see that those layoffs are ticking up a little bit. So AI disruption, it has a place in the stock market, and it's increasingly making itself known in the economy as well, Romaine.
Yeah, Katie, I love charts that make me squint as we kick you off to the close here on this Thursday afternoon. Let's bring Jason Pride into the conversation. He's Chief of Investment Strategy and Research at Glenmede. And Jason, I do want to start with the macro. We're going to get this jobs report tomorrow. Yeah. And, I bring that up, too, because most people have ignored the macro for the past few weeks as we look at AI spending, the CapEx boom that's led to this, what is now at least a 9-week rally. Do you think that there's any issues that we should be paying attention to with regards to the labor market and really the economy overall? Absolutely. So you guys have already kicked it off a little bit. You got to think about this, right? We have companies that are now spending almost 3% of GDP, right? Put this in the context. They're spending about 2.5-fold the magnitude that we spent on the Apollo space program in launching
AI at this point in time. This is a magnitude of spending that is, it's one of those things that changes corporate environments. So are there going to be companies that feel pressure because they've spent so much money on AI to actually cut labor on the other side of that? Yes, that's probably going to happen. We're probably going to see disruptions. I see CEO after CEO commenting about where they're going to find some cost savings in their labor base. At the same time, we have one of the largest ramp-ups in new business formation that's occurring at the same time. And historical technology cycles basically look like that. You get displacement in the jobs that pre-existed that are most easily automated and replaced, and you get a lift-off in jobs that you just couldn't even imagine coming about. I mean, to tell you the truth, 20 years ago, did I have any idea what an AI influencer was? No, but it showed up on the scene.
Yeah, I still don't have any idea what an AI influencer is, but it gets to the idea. But you make a good point, too, about this idea of sort of these big inflection points in our economy over history, whether from the ag revolution to manufacturing, manufacturing to internet. There's always been a disruptive transition period. I guess the question, and this seems to be what I think most people are concerned about, is when you look at the amount of money that's chasing after this right now, whether it's in public equity markets or the debt markets, has it gotten maybe a little bit too far ahead of itself, or does that not something
We're really asking these questions on a regular basis, and when you're talking about numbers of this size, you need to be asking those questions, because there's a double-edged sword here that this market and economy are going to have to grapple with. Number one is, have they spent too much, and you're not going to get the efficiency gains out of it, in which case there's going to be a comeuppance for those who have spent the dollars, which is bad for the market. Or if they've actually been successful in deploying this in efficient ways, then you get the job losses, which has implications for the company. So it kind of cuts both ways. I think long term, the story is probably still a good, positive story. But there may be this window here, just like every other technology cycle in the past, where you have a ramp up of efficiency, a ramp up in automation gains, a drop off temporarily in job opportunities, a slowdown in the labor market, only to later resume and us look back 5 years later and be like, what were we really worried about? But to say that now, 5 years in advance of being able to look back, is a little bit early.
So you think about, this AI build out, the CapEx spend being funneled towards it. It's had implications for the equity markets, but it's also had big implications for the bond markets when you think about all of the issuance that we've seen, not just when it comes to investment grade, but also in high yield as well. And I'd love to hear, how you're thinking about that, the AI trade, how it compares in equities to fixed income.
Absolutely. So number one is equities have gotten to pretty decent high levels of valuation. They're marking based on our models at about 90th percentile, which is kind of the borderline where we start getting a little bit more conservative or constrained in our portfolio allocations. What we've been advocating to clients is this is an environment where you actively rebalance back to targets, because you basically just don't want froth in your portfolio. You're trying to kind of just manage the risks along the way on an equity basis. Now, fixed income side of it, admittedly, we've been very hesitant to play in the private credit space, where actually a lot of that sits, because of the magnitude of money that's been chasing the same dollars of investment there up until now. And when we look at the private credit, and actually broadly the credit field, higher yielding bonds, the opportunity there in terms of what you're getting paid in terms of yield is actually relatively thin compared to other areas. We'd actually prefer to have that allocation actually still on the equity side rather than high yield bonds. That's in the corporate credit side. Municipal high yield is a completely different story.
Interesting. And you bring up private credit, and we have to talk about the fact that we're starting to get these redemption requests again. That was a big story coming out of the first quarter. We've heard from Cliffwater and Blackstone, some of the names so far, who are have received redemptions beyond that 5% cap, sticking to that 5% cap. You think about the sentiment overall, what is the contagion risk from what we're seeing in private credit into the public markets? Great question. I was actually walking through our clients on this last night. We took an approach of what's going on, do we care, and how much do we care, right? What's going on, you've already highlighted the slowdown in private credit, and the fact that we're now seeing these markdowns to the tune of like 85, 90 cents on the dollar in terms of the back-end financing collateral marks that the banks are giving it. So we're seeing the downgrades in valuations. Now the question is, how much do we care? And that comes in two parts. Number one, are you invested? For us, we've been hesitant to invest in that space. We actually don't care on that path quite as much for our client base, because we're very lightly exposed, if exposed at all,
all. On the flip side, do we care about it being systemic? And we went through the process of actually tallying up all the bank back-end ownership and lending and saying, okay, let's haircut it to zero. Let's see what it looks like. Let's haircut it to zero and see if the banks actually care. And after haircutting it all to zero, they're still above the capital ratios that the Fed requires them to be at. So I have this marked as not a systemic item related to the banks. Maybe we have a little bit of a question mark on the insurance side still remaining, but insurance is less capable of transferring into a contagion scenario.
All right, Jason, great stuff. We have to leave it there. Jason Pride, Chief of Investment Strategy and Research over at Glenmede, as we count you down to the closing bells as the S&P tries to recover from that big sell-off yesterday. We'll be back in a moment. This is Bloomberg.
SpaceX kicking off its IPO roadshow today with a 17-minute video explainer and lofty goals, including data centers in space and significant margin boosts by an unspecified date. Our next guest has invested in SpaceX 14 times since 2017 and says that this IPO is a catalyst to a broader opportunity. Joining us live, I'm pleased to say, is Space Capital founder and CEO Chad Anderson. Chad, it's great to see you.
Good to be here, thanks.
So let's talk a little bit about SpaceX because, you know, especially in the debate around whether or not it should be fast-tracked into a lot of these indexes, you know, those advocating for that often say that this is a very mature company. It's been around 4 decades, it's established, et cetera. You make the case in the notes you sent over to us, though, that this is still very much a growth story, though.
Yeah, I absolutely think that. I mean, so look, when you talk about valuation, it is an exercise in trying to price today tomorrow's growth, right? So at 100 and, you know, at 1.8 trillion, this is what 90x revenue of last year, right? But this is not a story about the past. This is a story about the future. And if you think about the deal that they've done with Anthropic has already cut that in half. So this, I think, because of the size of this, it is. Because of the amount of capital they're raising and the price that they're raising it at, I think that it's hard to sort of get your head around that this is still a growth story. But they're investing very heavily into infrastructure and the infrastructure of the future. AI is, all the big Mag 7 companies are all investing very heavily, raising a lot of capital to invest in AI infrastructure. I think the question is, how much bigger can this opportunity be?
Well, let's talk a little bit about AI and the deal that they did with XAI, which is another Elon Musk company, of course. There was some consternation. I have seen the point made that, you know, maybe the valuation of SpaceX would be even higher had they not bought XAI. That you think about how SpaceX is making money. It's the satellites that make the money, and then the AI side of the business burns the cash. And as someone who has continuously invested in SpaceX, I wonder where you fall in that debate.
If they didn't have XAI, it would cut the growth story significantly. So we know the TAM, we know the numbers that they're going after, $28 trillion, primarily AI infrastructure. They've done this before. The team has done the impossible. We've seen them do this countless times. And what they're doing, you know, they've brought a launch. They made launch and orbit accessible. That enabled them to do their connectivity business. And now they're extending that same platform to orbital data centers and AI infrastructure, right? So the growth story here is primarily an AI story where launch is an important capability and is a huge moat for them that no one else can really match.
Well, that's what I'm curious about is competition, you know, looking further out into the future. I understand right now there's a value proposition here that does have to do with the singularity of what they do, certainly on the launch side. But obviously, a lot of people are trying to sort of, you know, knock on the door here and sort of make their way into it. Do you, not so much worry, but do you anticipate that we will see more meaningful competition, both with regards to what they're doing on the traditional side of SpaceX, with regards to the launch and Starlink and that, but also on the AI front as well?
Yeah, so their focus on infrastructure gives them a real leg up. And what I'd say is that they make it look easy, and it is not easy. They make launch look easy. It is not easy.
Well, we saw that. I mean, we saw
Exactly.
everyone watch, the Blue Origin rocket last week, and so we know, and we saw all the failures for SpaceX over the years before they finally got it right. But they got it right eventually. So
But it's not,
why can't Bezos get it right, or why can't, I don't want to mention Branson, he's not going to get
They
it right.
might, and I really hope that they do.
Yeah.
But there's a capital efficiency story here as well. So look what SpaceX has done with $9 billion of capital. Jeff Bezos has spent 2.5, maybe more times that. We're estimating those numbers. And they're still struggling to make it to orbit. So SpaceX is a decade ahead in terms of launch capability, and the rest of the launch industry is catching up.
Bezos isn't it's not like he can't find another $2.5 billion. If Bezos said, I want to raise $200 billion, he would get that like that.
I guess what I'm doing is trying to put the pieces together. There's a capability story here, there's a capital efficiency story here, and there's an owning of the infrastructure that gives you a lot of decision-making capability of what gets built, how much of that capacity do you use for your own application and your own business lines versus what you make available to others. There's a really powerful story here when you kind of combine all of those things.
I'm wondering how investable this ecosystem is. Listening to some of the numbers that we're throwing around here, obviously space is a very capital-intensive business, to put that mildly. So what does the startup scene look like here? Because it's not like AI or a tech company where you just need kind of vibes and a few lines of code and a dream and you can go for it. This is a much different sort of sector, and I would imagine a much different opportunity set.
The space economy is much broader than just rockets and space stations and moon bases. This is actually a real validation of our thesis, where we've been talking about the infrastructure that is in orbit, the distribution that basically accesses that, makes it accessible, the applications that are built on top of this really valuable data. The way to think about this kind of helps put into perspective is that 24 GPS satellites generated trillions of dollars in economic value. The entire modern economy runs on GPS, 24 satellites. Today, there's 18,000 satellites in orbit. SpaceX has half of those. Between now and 2040, there's going to be 2 million satellites launched. SpaceX is talking about owning many of those satellites as well, but there's half of those are other companies that have filed to launch orbital infrastructure as well. So this is addressing all kinds of needs across enterprise, civil government, and also defense.
All right, Chad, always great to get your insights. Chad Anderson there, the founder and CEO over at Space Capital, and with a focus on tech and a focus on AI. We do want to go out to San Francisco, where the Bloomberg Tech Summit is taking place right now. And you see there, right there on stage, is Fei-Fei Li, the co-founder and CEO of World Labs, widely considered to be one of the godparents of the AI revolution. She's in conversation right now with Emily Chang, the host of Bloomberg Originals, a Bloomberg Tech event in San Francisco. Let's take a listen.
First of all, I think we have an incredible team. We have the conviction.
They don't have the godmother, that's for sure.
But the world is big, and I think this is just like LLMs. I think there will be many companies doing incredible work in world models. Just as 24 hours ago, we kind of got fed up that the word world model has been so confusing and being used in so many different ways that we actually put out a blog just explaining what a functional taxonomy of world model is, instead of mushing everything together. And the way I see it is, right now there are 3 ways of calling world models when it comes to spatial intelligence. One is what I call a renderer, when the model puts beautiful pixels on the screen, mostly like video generation model. And the consumer is mostly human eyeballs. And while the model commits to beautiful pixels on the screen, it doesn't necessarily commit to physics and dynamics and geometric correctness, because that's for just consuming, human eyeball consuming, not necessarily for computation and other tasks. Then another kind of world model is what we call a planner. That is more for machines, more for robots, where it outputs whatever the input is, the state of the world or the action, it outputs a correct action to take to the next step. And you see that kind of world model a lot for robotics applications, and you hear that in that context. The third kind, which I think is the linchpin of the 3, is a simulator. is that it actually is.
And you're watching Fei-Fei lead one of the godparents of the AI revolution in conversation right now with Emily Chang, the co-host of Bloomberg's Originals show of The Circuit. You can type live, go on your Bloomberg terminal to continue watching that conversation. Meanwhile, right here on The Close, we continue to count you down to the bells with with a look right now at some of the big movers on the back of analyst recommendations. It's our top call segment, and we start off with Broadcom. Macquarie downgrading to neutral. This after the chip maker reported that underwhelming outlook for its AI chip sales. The analyst sees Broadcom's app-specific integrated circuit revenue actually peaking next year. Those shares having the worst day in about 16 months. Next up, let's take a look at Five Below, another earnings story that failed to impress. Jefferies keeping its hold rating for now, but trimming the price target to a street low $210. The analyst questioning why the retailer's growth rate is peaking, given the pricing tailwind, in his words, are already behind us. I know, Randall, but that stock now down the worst day in about 14 months. And finally, another retail earnings story. PVH. Calvin Klein ain't no friend of theirs. Evercore ISI downgrading the parent company to inline, slashing the price target to 79. The analyst calling the report a low-quality update. No love story there. The share is plunging the most since Black Monday, October 19th, 1987. Those are some of our top calls. Let's stay in the retail space and take a look at another laggard in that space, Lululemon. The share is down today, down about 20% since their last earnings report. In about an hour, we're going to get their next earnings report. Joining us right now to talk a little bit about what to expect is Stacey Widlitz, president and founder of SW Retail Advisors. And obviously the big asterisk here is that we're still waiting for their new CEO to take over, which, of course, doesn't occur to September. So a bit of a maybe gap quarter, if you will. What do you expect?
So we've seen Lulu languish and lose share over the last 2 years. It's been missteps in product. It's been controversy at the top. It's been leadership changes. And as you say, there's this big vacuum here. So, we're looking at the comp coming out in the print, and last quarter was down 1. Will it be similar or maybe a bit worse? That's the big question here is, are they continuing to lose market share to Alo and Vuori and others? And also, if you remember, American Express last September started offering the customer a credit of $300 a year on Lulu items. And even that has failed to move the trajectory of the comps in the U.S.
Yeah, certainly bleak when you put it in that context. And that story that you described for Lulu, the idea that they've been losing share to some of their big competitors, including Alo, how much is that a U.S. story versus global as well?
It's the biggest chunk of it. It's 70+% of the business. And, we heard from PVH today, a lot of that weakness was Europe. It was talking about Middle East concerns and conflict concerns, and Europe really deteriorated. So, Lululemon is pretty new in Europe, but I will say I spend a lot of time there and looking at the Alo and the Vuori stores popping up directly across the street from Lulu. I think we have to brace for additional concerns on the European side. But the bulk of the business and what we really care about is North America and those comps, those negative comps continuing to get worse.
I'm curious, Stacey, when we talk about the potential for Lulu to turn things around, is this going to be more about organizational management? Is this going to be more about pricing? Or is this going to be more about brand identity? And we talk a lot about that on this show because, after all, a lot of these companies, at least the consumer-facing ones, their big value is less in the product themselves and more in how they market that product. This was an iconic company. It still is. And it set the category for athleisure. Can it get that back?
It did. It used to own the category. But interestingly, Lulu is actually a technical product. And it's also a product that is skews for demographics slightly older than Alo, for example. So their loyal customers that used to go in and buy multiple leggings and look for the new colors and the new innovation of fabrics, that's actually what's been lacking. They've been going heavy logo. And again, they've had some product problems in general that they had to pull off the shelves. So in my opinion, this is actually a product issue. And interesting enough, one of the deals that Chip Wilson, who was the founder, who they just had the board shake up where he's going to get a few seats. One of the seats, he wanted them to agree to having a product person come on the board. What a novel idea, because that is the problem here.
All right, Stacey, have to leave it on that note. Great to preview some of the action with you. That is Stacey Widlitz. She is president and founder of SW Retail Advisors. You love athleisure.
Yeah, I do. Yes, I wear it every day. I'm wearing it now under my suit.
Wonderful.
Do you? We didn't get a chance to ask her about the logo. Do you know the origin of that Lululemon logo?
I have no idea, but I know that you know.
So I looked this up because I was curious as to why there was so much hatred for it. So apparently he originally wanted to name the company Athletically Hip. And that was actually supposed to be an A.
Ooh.
And then at some point he changed to Lululemon, but said we're still going to keep the logo.
I would say it was a good move changing to Lululemon.
Yeah. I know that's true, but that's what ChatGPT told me.
I believe you, Romaine. We're going to talk a little bit about Succession next with Simon Gallagher.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these broader markets, also keeping an eye on Netflix as well, having its annual meeting today.
Starts in about 2.5 hours, and it's a normal run-of-the-mill shareholder proposals that'll be rejected. But really, this is a big milestone because officially, once that meeting starts, Reed Hastings will actually no longer be the chairman of the board. Obviously, a title that he has held in some capacity or another since the company's founding back in 1997. Of course, he stepped away as CEO back in 2013. But this more or less severs his formal ties with the company. He still owns like 21 million shares, so he'll have some say if he wants to or not. But it just raises the whole idea of kind of what the next chapter is for Netflix, given what he's built over this last 28, 29 years.
Absolutely. A question that's been asked of Netflix, especially when you think about how they're thinking about M&A, going forward from here, and of course, what's next when it comes to the competitive landscape. So let's discuss that future a little bit with Simon Gallagher. He is Managing Director of Entertainment Consulting and Investment Firm SPG Global. He's also a former content acquisition executive at Netflix and former Director of Strategy and Business Development over at Hulu. Simon, all of that is to say, it's lovely to see you. Romaine and I were having a vibrant conversation in the commercial break about how when I eat dinner, I don't turn on the TV and go to Netflix. I usually put on YouTube and watch Hot Ones, for example, with my husband. And you point out in your notes that that's the fight that Netflix is fighting right now, fighting with YouTube for those eyeballs.
It is. 5 years ago, we would have been sitting here talking about the challenge from Disney Plus and Paramount Plus and HBO. Now it really is about that share of audience time and how much time the audience has to consume content during the day. And as you suggested, people are going to YouTube as their default setting at the moment.
Yeah, well, you think about just the ease of, because I'm just talking about myself, turning on the TV seems like a big task, Simon. But anyway, where does this competitive landscape, which is increasingly YouTube and it's Netflix now, where does that leave, the Paramount Pluses of the world, the Disney Pluses of the world? Because 5 years ago, as you said, that was the fight that everyone was expecting.
Look, they're chasing hard, but I don't know if the motivation is there in the same way to chase after Netflix. There's a feeling that can we even catch them? Even if we hit a whole bunch of home runs, can we even catch up to Netflix? And is that even the right business for us to be in? Is premium subscription content the right business, or is it a hybrid of one of those content models?
I am curious, too. I mean, we've been holding a big tech event out west, and yesterday, one of our colleagues had a chance to catch up with Elizabeth Stone, who's basically the Chief Product and Technology Officer over there. And something struck me about what she was talking about. She obviously, kind of talked in her book, but the idea of just how much more important the underlying technology is now that Netflix is moving deeper into live events, and of course, we saw some of the glitches that they have with some of the earlier attempts at that. And I do wonder about how much they have to transform behind the scenes as they move, or actually broaden out away from just scripted programming into these live tentpole events that are going to, and for better or for worse, going to be how people view and evaluate them.
Look, you've touched on a really key point, because the production quality of the first Netflix live sport event, which was a golf event, you may recall, in Las Vegas, was horrendous. The first MVP, which is the Paul boxing MMA or boxing event, was the first one. Again, a little bit better, but not much better. And more recently, the MMA event with Gina Carano was significantly better. So it is a significant technical challenge to work out how to produce sport, how to deliver it. And there's a technical challenge behind that when live is so important to the broadcast. This is not content that's been ingested and can be viewed from different places and uploaded from different places. This is live and it has to get around the entire world in seconds. So it is a big challenge, but it's also that production challenge, and you need to have the right producers for that type of content. And now I think they're getting there, and they've improved significantly, but they've still got a little bit of a way to go to catch up with the production quality on Fox Football on a Sunday.
Yeah, oh yeah, absolutely. The other aspect of it, and it also came up during the conversation, was obviously some of the moves they've made into podcasting, and I kind of put that in quotation marks because that's kind of morphed into a whole different medium. But I do just wonder about the value proposition of it, because we've seen some of these podcast companies as standalones, and we know the economics can be, let's just say, a little dicey, to say the least. What is the value proposition for them to expand deeper into that space?
Well, it's a real challenge, and I was thinking about this last night in preparation for the call. The production costs of podcasts, as we know, can be done very cheaply. The challenge is they're going after some marquee talent, and what sort of minimum guarantees do that marquee talent want to live exclusively on Netflix or on a Spotify Netflix hybrid type distribution model? And that's where it starts to get very expensive very quickly. But what Netflix is trying to do is own the audience through each stage of the day. Now, you might consume your podcasts on the way to work, maybe on the subway, or then you're watching, YouTube when you're preparing dinner, and then you're sitting down to long form content. Netflix doesn't want to lose the audience through any stage of that, and they recognise that people are going to YouTube and consuming a lot of the podcasts because the podcasters are putting so much effort now into the video that lives behind the actual conversation.
I would just also like to point out, Katie.
Please.
We don't allow devices at our dinner table in our household.
That's really noble.
Not to impress my values on you, but
something for me to aspire to as I enter my next phase of life. But let's talk a little bit about podcasts, because it sounds like Netflix, of course, would like me to have a lot of devices at my dinner table, all of course, playing Netflix properties. And I love the way that you phrased it in your notes that you were kind of describing just now, that podcasts solve Netflix's frequency problem. That is the hope there, that is going to basically increase your engagement. Maybe they're winning on long form, but podcasts, it's a lot more touch points.
Yeah, absolutely. As I say, you want to try and hold on to them through each stage of the day, wherever they're consuming content. And at the moment, they're not quite doing that. And as we've already alluded to, they're losing people away to YouTube. My bigger concern is, are they doing enough relative to, and particularly as we look at Reed Hastings exiting the board and the company that he co-founded, are they looking at growing the business, or are they just thinking about long-form content and how can we do our traditional business model well? Or are they starting to say, well, what else can we do well? How can we leverage the 325 million credit cards that we have on file and build adjacent models or perhaps alternative business models in the content space? And that's what I'd love to hear more from them, which at the moment, they've done a little bit in gaming, and they've obviously an alliance with Spotify. They're stepping into sports, but it's still very much about what exists for the subscriber under their current plan. And I think there's a lot more that they could do, as I say, in the adjacent and perhaps leverage those credit cards they have on file to offer up something different.
All right, Simon. Always appreciate it. Simon Gallagher, he's managing director at entertainment and consulting investment firm SPG Global, and of course worked over in the past at Netflix and Hulu. I am curious, Katie, what is do you listen to podcasts? Do you have a favorite podcast?
My favorite podcast is probably my own. It's called Money Stuff. I co-host it with Matt Levine. It comes out on Fridays. But on a real note, plug. My favorite podcast is Case File. It's like this Australian true crime podcast. I listen to it to go to sleep.
Okay.
Yeah.
To sleep?
Yes.
Interesting. Okay.
Yeah, I have terrible dreams.
I prefer things a little more upbeat, so.
Yeah. That fits.
All right, we continue to count you down to the closing bells here, and it's not tech leading the charge. Today, it is healthcare. As a group in the S&P, up about 3%. And there's a big conference coming up next week, led by Goldman Sachs, taking a closer look at the healthcare and pharma business. We're going to catch up with Asad Haider when we come back after the break. This is Bloomberg. Time now for our stock of the hour, and it's really a look at the sector. Shares of pharmaceutical and healthcare companies up for a second straight day. A strong tape once again here, as a lot of folks looking at maybe what the potential might bring for the year to come. Let's bring into the conversation right now Asad Haider. He's Goldman Sachs' head of global Goldman Sachs' Global Annual Healthcare Conference, which kicks off on Monday. Asad, great to have you here.
Thank you for having me.
When we talk about some of the strength that we've seen lately, and some of this is just the rotation that's been going on in public markets, but there has been a lot of chatter here about some of the longer-term opportunities out there in the healthcare space. And I am curious as to what's going to be kind of the big focus next week when the conference kicks off.
Yeah, thank you for having me. So today is very much about just these rotational macro dynamics, and I think one of the big confounding factors in healthcare subsectors across the board this year has been this inverse toggle with tech, and obviously what's happening with Broadcom today, with the little bit of cold water on the AI trade, is factoring into price action in a lot of healthcare stocks, and I think it's creating that these types of days create a very challenging environment for the long-short community because it's not micro, it's all macro. Things tend to move together in a highly correlated way. And so what we're hoping to explore next week, where we will have all 6 of the large cap pharma companies that are under our coverage, is explore some of the more idiosyncratic drivers behind each company. And each name has its own different theses, different idiosyncratic drivers. There's been a lot of performance dispersion year to date. For example, within the pharmaceutical sector, you have Merck up about 13% on the year. On the other side of that, you've got AbbVie down about 2%. Everything else sort of in the middle, all for different reasons. And in terms of some of the mega themes that we're hoping to explore, it'll be things like M&A, it'll be things like AI, China, obesity, which is very much something that's capturing people's mind share. So those are the things that we're looking for.
Well, let's tie together 2 of those themes, obesity and M&A, because certainly we've seen that heat up over the past few months, over the past years or so. And I wonder, I have to imagine that's the elephant in the room at a conference like this, where you do have all of those heavy hitters all together.
Heavy hitters is a great word. There is certainly a lot of heavy-hitting firepower across the pharmaceutical industry. By our estimation, we'll calculate based on our standard leverage models of, call it debt to EBITDA 2.5 times. The industry has about $650 billion of M&A firepower, and these companies are on the cusp of these major patent cliffs, LOEs, and so they need to look for ways to replenish their pipeline. And it's been an active M&A year. And one of the things that's been encouraging to hear some of these companies talk about is the names that don't need to do immediate deals because their patent cliffs are quite far away. So names like Eli Lilly and AbbVie are now starting to open the aperture a little bit on deal activity. Lilly's been extremely active on the year. AbbVie's been signaling more deal activity, and so our expectation is that M&A is going to continue as a theme in the sector.
Just real quickly, only about 30 seconds, but I am curious about the China theme and where the opportunities are there.
Yeah, well, China's been a big focus for several years. I mean, we just got out of the ASCO conference. There was a lot of focus on Chinese participation, China data. There is a big debate right now about the translatability of studies that's run in China to the global population, particularly in areas like oncology. And that's why, you've seen some of the bloom come off some of the names that have been partnered with these China companies. But we expect that to continue to be a source of a lot of innovation. There's a lot of exciting stuff going on over there, and we expect that partnering to continue.
Well, certainly looking forward to the readout from next week's conference. That is Asad Haider. He is head of the healthcare business unit within Goldman Sachs Research. And coming up, it's the closing bells. We're going to take you there with Eric Van Nostrand. He is CIO at Lazard Asset Management. That conversation up next. This is The Close on Bloomberg.
Equities have gotten to pretty decent high levels of valuation. They're marking, based on our models, at about 90th percentile, which is kind of the borderline where we start getting a little bit more conservative or constrained in our portfolio allocations. What we've been advocating to clients is this is an environment where you actively rebalance back to targets because you basically just don't want froth in your portfolio. You're trying to kind of just manage the risks along the way.
Jason Pride over at Glenmede, characterizing the bit of the rotation we've been seeing underneath the hood. As we kick you off to the close here on this Thursday afternoon, a bit of a turnaround from yesterday. We had a pretty significant sell-off that was largely because of some of the concerns about AI, private credit, and the state of the economy. Bit of a rebound today, but once again, it's not necessarily into those tech names. It's into healthcare and some of the other things we've been talking about.
Yeah, and perhaps it's a healthy sign that you do see the S&P 500 higher by about 0.5%. At the same time, you have the NASDAQ 100 down 0.4%. The Philadelphia Semiconductor Index, a lot of those chip names down even more. The fact that even still the big index is able to post a gain certainly speaks to that broadening out that a lot of folks have been calling for.
Absolutely here. And just a reminder, we are going to get another read on the consumer after the bell tonight, as well as tech. Lululemon set to report in moments, as is DocuSign on the tech side. And that kind of wraps up earnings season, right? You can't really get much smaller than that, right? Anyway. We count you down to those closing bells. We're just about 9 minutes away, 8 minutes away. Let's bring Eric Van Nostrand into the conversation. He's CIO over at Lazard Asset Management. He joins us here in studio too. The first ever CIO over at Lazard. Congratulations.
Thank you. It's good to be with you, bro.
Also, we should point out, former Assistant Treasury Secretary. And I should also point out too, yesterday sitting in that seat was Gary Gensler, who was also the recipient of the Alexander Hamilton Award, which is
also a former Assistant Treasury Secretary.
Yes, that's right. So anyway, now that we've gotten all your accolades out of the way, I do want you to kind of put on both your hat as CIO, but also your hat with your sort of institutional knowledge of economic conditions. And when you look at sort of where we've gone in this market, and I'm talking primarily in public markets over the last few weeks, everyone kind of shrugging off the concerns about higher oil prices, higher gas prices, the still choked up Strait of Hormuz. And yet we are at record highs for the most part on all the major indices here in the U.S. And I do wonder if there is something to justify that, or is this just the speculative aspect of it has taken over?
Yeah, it's absolutely the right question to start with, Romain. When you look broadly at the equity market and at the global constellation of fixed income and commodity markets, it looks like there's an enormous disconnect animating market sentiment today. Because even cutting through the volatility of the past couple of days, we're still very close to all-time highs in global equities, especially U.S. equities. At the same time, we are in the midst of what is the biggest supply contraction in my adult life and in most investors' adult lives right now. And that tension is one that I think can only resolve itself through meaningfully higher inflation over the year to come. And that's the main thing that's got us worried at Lazard right now.
And well, we saw that worry kind of bubble up yesterday, because a big part of the reason we had the sell-off in equity markets was because of that increase that we saw in interest rates, the increase we saw in oil prices. And that seems to be the cliff everybody's looking at here, is that, if cost of capital stays where it is, maybe these valuations are justified. Certainly if cost of capital goes down, they're really justified. But if we do start to get a meaningful uptick in interest rates, and which brings me to my question. Do you anticipate we will? And if so, what is the effect?
So I do think we're likely to see upward pressure on long-term rates, regardless of what the Federal Reserve does to short-term rates in the medium term. And I think what's happening there is a lot of structural forces are looking past the short-term demand factors that is going to drive the Fed's hand. The way I think about it, most investors working today have spent their whole careers focused on demand management. Is the Fed going to stimulate enough? Is the Treasury going to spend enough to get us out of whatever recessionary hole we're in? Past couple of years, and 2026 in particular, have really been about changing supply constraints. On the upside, is AI going to deliver some big productivity boom? That's an upward shock to supply. And on the downside, is this oil shock going to keep the global economy from producing? And that tension is what's really at the center of what markets are doing right now.
So the long end moving independent of what the Fed is doing at the short end. I mean, is it too simple to say that adds up to a curve steepener? I mean, what are the investable implications of that?
Yeah, so within fixed income space, we like staying further away from long-term bonds because regardless of what the short end does, we are worried about the long end in that regard. I think in the near term, the Fed's job for the front end is it's as hard as it's been in modern history, because they've got this supply shock and growth questions at home kind of pulling them in opposite directions. And how they handle that inflation is going to be key. For my money, you're better off focused on the long end, where the structural trends are kind of cutting all in the same direction. It's why we've seen the long end yields increase in the way they have. And I think it's going to be driven further by rising inflation expectations over the course of the next couple months.
And do you think that there is a read-through? If we do see the long end continue to move higher here, is there a read-through into the equity market? That point has been debated, and certainly you think about the AI trade. It doesn't seem to be making too much of a dent, but you think about the equity market more holistically. I mean, what does that structurally higher rate environment mean, maybe medium, longer term?
Every economics textbook is going to tell you that there already should have been a meaningful read-through to softer equity markets from the oil shock and from higher interest rates. The fact that there hasn't been is evidence of the potency of the AI trade and the enthusiasm with which investors are pouring new money into some of those names. But that can't last forever. That's not sustainable. Eventually, the upside around some of these names is going to be priced, and interest rates are still going to be where they are. Traffic in the Strait of Hormuz is still going to be as low as it is. And that combination is something we're defensive about for global equities in the near term.
Well, speaking of defensiveness, I mean, we're not seeing it today, but one sort of pattern that had emerged over the last few weeks was the outperformance that we saw in non-U.S. markets.
Right.
And there are some distortions there, which you should point out, obviously, particularly with the EM indexes kind of all being driven by like, 3 Korean, chip companies. But even when you get past that, there was a meaningful discussion and a meaningful move in fund flows into emerging markets. Do you anticipate that is less cyclical and more structural?
Yeah, so I think emerging markets right now are the beneficiaries of a big set of structural forces that, perhaps counterintuitively, given the war in Iran, are going to lend a lot of energy to emerging markets from here. I think structural dollar weakness compared to the diversification we're seeing from global reserve managers, sovereign wealth funds in the global south, are going to keep lifting EM. The normal counterargument to that, the normal thing that would make you worried about EM in an environment like this one, is usually when interest rates go up, even in the U.S., that tends to hold EM back. But I think that transmission mechanism is broken. It makes me very optimistic.
But I am curious about this because I feel like EM has always been, not to say always, but it frequently ends up being a trap. But people look at the value, the money goes in, and then you realize why these companies are called emerging markets. I mean, they have instability in terms of government, instability in terms of market controls, and when those pop back up, then everybody flees. And where do you go? You go back to the world's largest economy and the most liquid financial market.
There's no question that the risks in EM are higher than the risks in DM. But this environment is one where I think investors are about as well suited to get paid for taking those risks in terms of the returns as they've been in a while. Because you see the dollar's stranglehold on global investor sentiment easing pretty meaningfully. We don't talk about that as much recently. We've kind of been distracted by the cyclical nature of the war and the risk-off flows that have buoyed the dollar a bit. But structurally, I think the longer trend toward dollar weakness is poised to persist, which should give a lot of legs to EM from here.
Let's talk about international developed markets a little bit too, because you mentioned the war, you mentioned the oil supply shock. It feels like that definitely has been felt when it comes to Europe, when it comes to Asia, and you think about especially 2025. That was one of the big trades. Basically diversifying into Europe, especially, and I wonder how that has held out, what the future of that is.
Yeah, so I've been criticized in the past, I'd even say probably mocked in the past, for too persistently liking U.S. equities relative to Europe and the rest of the developed world. Now, not to humble brag about it, but really until 2025, that was usually right. All that said, I am more bullish about European equities than I have been in a long time right now. Principally because I think they've gotten themselves into a better position with regard to their monetary and fiscal policy posture than the United States have in terms of their ability to weather some of the supply shocks we're seeing from here. And I think that they probably haven't seen some of the overvaluation from enthusiastic retail trading around EI that U.S. stocks have. And I do like the European equity complex relative to the U.S. here.
Eric, a great conversation. Eric Van Nostrand, the CIO over at Lazard Asset Management, as we count you down to the closing bells. And it does look like the S&P, the Dow, and the Russell are going to hold on to their gains heading into those bells. So we are seeing a little bit of selling pressure in the NASDAQ into the tape here. Obviously, a lot of concerns here about those valuations we saw in Broadcom and Ciena and some of these chip and optical stocks. It maybe got it too far ahead of themselves.
Yeah, absolutely. Broadcom, one of your biggest weights, the biggest weight on the S&P 500 today, even though, as you said, looks like we're going to close higher on this Thursday.
And you take a look at the closing bells there, the Dow Jones Industrial Average higher by almost 900 points, or about 1.7%. That is your leader here on the day, 51,562. If you care about the price weighting, Katie Greifeld, that is a record high. As far as market cap weighting, the S&P 500 up about 31 points, or 0.4%. The NASDAQ Composite and the NASDAQ 100 each going to close in the red, and the Russell 2000 a pretty decent gain on the day, though just shy of its record high, but still higher by about 1.5%.
Big day for the little guys, and I'll play Carol Massar here and tell you that when it comes to the S&P 500, looks like 361 names finished in the green, 139 in the red. So, you know, a pretty broad rally, even though, as you can see on the sector level, as measured by the Circle, information technology as a sector down by 1.4%. Your biggest loser on the day. Consumer staples also falling, but just barely. In terms of what pushed us higher today at the sector level, healthcare, as we mentioned, higher by more than 3%. Financials as a sector higher by about 2.7%. Communication services higher by 2%.
As far as the notable gainers and decliners, it's basically your United Health and Goldman Sachs. In fact, a lot of the financial companies got a pretty strong bid. Blackstone, Humana, Robinhood, your three biggest gainers in the S&P, but to the downside. And that is where a lot of the conversation is today in the S&P 500 in order. Ciena down 14%, Broadcom down 13%, and Micron, everyone's darling, down about 8%. Jonathan Levin joins us right now, Bloomberg opinion columnist who's been writing a lot here about the AI rally and the AI boom, an AI boom that I think even the bulls would agree probably got maybe a little bit overheated. But I guess my question here, Jonathan, when you look at sort of the reality check we got today as well as yesterday on the trading day, is there a sense here that maybe this rotation out of some of these names might become, well, not necessarily permanent, but maybe a little bit more longer in the tooth?
Yeah, I mean, it makes some sense. I think basically what we're seeing here is that markets are forward-looking. You know, interesting to see healthcare doing well on the day. Healthcare has really been the rare underperformer this earnings season, the rare sector in the S&P 500 that actually saw a year-on-year earnings contraction. But we now see markets looking ahead, as they tend to do, and saying, you know what, Q1 was fantastic for the likes of the semiconductors complex. It was pretty lousy for the healthcare complex. But now we turn the page, and where do we go next? Semiconductors are kind of priced for perfection here. We see that in the U.S. We see that in South Korea. Healthcare, on the other hand, if you believe that the sector can turn things around, if you believe that there's still some upside to this GLP-1 story, if you believe that the policy headwinds are behind drug makers, then maybe it is a moment to take a flyer on something like healthcare.
Absolutely, and that certainly has been some of the bullish rallying cries around healthcare as a sector over the past several months. Maybe, of course, those stars will align and we'll see something there. But I'm reading a recent column of yours. You know, you call out AI. It's really been a single narrative market. This market loves a story, and the story that it loves is AI. But you know, you also bring up energy, and certainly it's been kind of a hot and cold trade on energy when you think about the past couple of months and what we're seeing with the situation in the Middle East.
Yeah, I think that investors just really want to think carefully about how exposed they are to the AI trade. I mean, at the end of the day, a massive chunk of the S&P 500 and, of course, of the NASDAQ is composed, A, of your direct exposure to AI, and then the beneficiaries of AI CapEx. And then there's another layer of, like, consumer companies and folks like this who are essentially benefiting from the wealth effect generated by this bonanza. So how do you get any real diversification? Maybe it's in healthcare. That's, you know, what we're talking about today. But maybe it's also in energy. If you just look at the very recent history, I did a little bit of a data exercise in my most recent column. And if you want to actually reduce volatility and improve your Sharpe ratios, energy has been the place to go. Of course, this is never investment advice. This is based on backward-looking results. But you know, given the other big narrative out there, which is this, you know, trade decoupling around the world, a secular increase in geopolitical tensions, energy is not a bad place to be.
All right, Jonathan Levin, Bloomberg opinion columnist, a closer look here at what's been moving the market and, more importantly, a closer look here at that big AI trade. But we do want to pivot away from AI and go back into the world of consumer retail. We are getting earnings crossing the wire right now, I believe, from Lululemon. This is obviously a company in transition, an interim CEO. The permanent CEO still doesn't take over until September. Here's what the numbers show for the quarter that just passed, and basically match analyst estimates on the bottom line for the quarter, $1.69 a share. Revenue relatively in line with estimates, $2.47 billion. The company, though, says that for the full year, it is expecting net revenue of $11 billion to $11.15 billion. That's a slight nudge lower from where it had guided before at $11.35 to $11.5 billion. As far as the bottom line numbers go, it says expect EPS of $10.95 a share to $11.15 a share. Again, that's a slight nudge lower from its previous guidance of $12.10 to $12.30 a share. Gross margin also contracting in the most recent quarter. And overall, when we talk about that comp sales growth, of course, something that everybody pays attention to, there is none. Total comp sales, ex-FX, down 2%. The street was looking for a contraction of 0.25%. That is your picture right now, and that is why the shares, Katie, are down about 6%.
Yeah, taking a look at the commentary from the company saying that the guidance does not reflect any potential IEEPA tariff refunds or future repurchases of the company's shares. So keep an eye out for buybacks, I suppose, but remain, as you mentioned, shares really taking a hit after hours, now down about 8%. I mean, expectations seemed like we're pretty grim heading into this print, but still you can see that disappointment coming through.
Yeah, we're going to dive a little bit deeper into those numbers a little bit later here on The Close. But I do want to draw your attention to DocuSign, the electronic signing company that a lot of people have said is under threat by the threat of AI. Those shares down about 2% here in the after hours trade. The first quarter results above estimates, $1.09 a share. That's the bottom line. The street was looking on average for $1. Even if you don't adjust, it was still a beat. Gross margin in line with estimates at 81.5%. Free cash flow above estimates. But here's your forecast. The company says that for the current quarter, revenue will be $865 to $869 million. The street was looking on average for $866, so kind of in the middle of where that range is. For the full year, the company says $3.5 billion is basically more or less what it expects to earn in revenue. That's more or less what it had guided to before. If you want the exact range, it's 3.49 to 3.50. The previous range was 3.48 to 3.5. So basically, we're just nickel and diming here. This is a company, at least for right now, not really guiding any higher than where it had prior.
Well, let's talk a little bit about Rubrik as well, because those numbers crossing the terminal. We got their second quarter revenue forecast beating estimates. Some good news finally here for Rubrik. They see second quarter revenue between $395 million to $397 million. The estimate had been for $383 million, so certainly a beat there. You can see shares higher by about 3%, had been higher by as much as 5%. In terms of the quarter that was, their first quarter total revenue coming in above expectations. So too for first quarter adjusted EPS at 16 cents, had been anticipating a loss per share of 3.1 cents. So you add it all together, again, Rubrik shares, they had been moving higher, but you can see flip-flopping right now as we really parse through these results in real time.
Yeah, I love their cubes there. All right, when we come back here on The Close, we're going to take a deeper dive into the world of the consumer. We have a big jobs report up ahead tomorrow. We're going to actually talk to one of the key players over at Nike, and we're going to dive deeper into those results that we just got out of Lululemon. That's coming up next here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. Katie, you were out yesterday, and there was a lot of activity in this market, a big downturn, as a lot of people started to reassess some of those tech valuations. They started to assess economic conditions and said they didn't want any part of this. But, of course, as we've seen time and time again, all you need basically is to sleep on it and people decide, okay, there is value to be found. You found that today, not necessarily in tech, but in healthcare stocks. You found that today in financial stocks, and that was enough to lift the S&P 500 back towards that 7,600 level, up 0.4% on the day, and enough to lift the Dow to a fresh record high. Meanwhile, Bitcoin had a lot of selling pressure yesterday when you were gone. That continues today, now down around that 63,000 mark.
Yeah, big yikes that we're getting closer and closer to 60,000 per coin. We'll keep an eye on that. But let's talk about some of the individual movers on the day. I wanted to start with Blackstone. You saw a lot of those private credit worries reignite this week. Blackstone really sold off yesterday, as I understand it. When it comes to BCRED, they're going to enforce that 5% cap when it comes to withdrawal requests. You can see shares higher by about 7.5%. Ciena reported today. I understand that Romain Bostic spoke to the CEO. We'll be playing out that interview later. Shares down about 13.7%. And Broadcom reporting yesterday. You can see how markets received that one, down about 12.6%. But let's get to our top story this hour, and that is an AI chip sell-off making way for a blue chip rally. You had the Dow Jones Industrial Average closing at a record high after its best day in nearly 2 months. Healthcare and financials behind the bulk of that move, with tech the S&P 500's only laggard. Now, on the consumer front, Lululemon results just crossing the wire, which really provides a little bit of a read here on where spending stands with more economic data ahead. But you take a look at the reaction right now, you have to wonder how much of this is a Lululemon specific story, Romain, versus something that really tells you a real story about the economy at this moment.
Well, the company says in the statement, Katie, that they've been navigating headwinds that led them to adjust their outlook for the full year. That adjustment is to the downside, slightly to the downside. And that's after a quarter where we saw comp sales contract by 2%, with comp sales in the U.S. down about 6%. Deborah Weinswig joins us right now, the founder and CEO over at Coresight Research. And I'm not sure where you want to start here, because Lululemon, of course, has been dealing with a lot of issues from sort of the macro issues and sort of, I guess, broader factors, but also a lot of own goals with regard to their own management and marketing. What's going on?
Well, Romain, first, thanks for having me on. And I think we know that the print was even a bit worse than most of us thought it would be in terms of comp store sales. So there's that. And I think the question right now is this more structural or cyclical? And you've got this interim period where, right, you've got interim CEOs. So either you're setting this company up for a phenomenal kind of place when the new CEO comes in, or there's a bigger story playing out. But I think it's more about the brand itself than it is about the sector.
I am curious, and I know there's a lot of issues as to why Heidi O'Neill, the new CEO, can't actually start until September. That almost seems like a lifetime away right now when you consider the straits that Lululemon is in. And I am curious as to what you think she can do on day one to reset the tone, if not certainly organizationally, certainly in terms of the sentiment and just generally the perception of what this company can be again.
Yeah, I think that I feel like if we go back a few quarters, there were some challenges on the product side, which, right, they've had, a miss here and a miss there, but it seems like they've fallen down now and can't kind of get up. They've had fit issues. They've had kind of, wrong size issues, just not having enough of certain sizes. And if you start to think about where we are in this kind of like GLP-1 story, this sector should be one of the greatest beneficiaries, but Lululemon is just not participating right now.
Yeah, no, it is a bit of a head scratcher there. And, you think about Heidi O'Neill coming in and you think about her past. I wonder, how you expect that to interact with what Lulu is dealing with when it comes to international markets. I mean, you call on your notes China, Mexico, et cetera, but we know that globally it's been a bit of a struggle as well, particularly when it comes to Europe.
Yeah, I mean, I think the bright picture here has really been more around their China story. That's been the real standout. I do think Europe has been, I think it's an opportunity for them. And that to me is a fairly significant one. So if we look kind of down the line, if you will, right? I mean, North America is where I would start in terms of size of market. Then you have Europe. I mean, China's been doing well, but international revenue overall, I don't think grew as much as we would have expected this quarter. So I think there's going to be, opportunity across the board for her.
let's talk about opportunity potentially when it comes to men's, because anecdotally, I mean, I can think of so many conversations I've had about how great Lululemon's men's selection is. You know, I see that with my own husband, and certainly when it comes to their pants in particular, but it doesn't seem like that's necessarily moving the needle here, even though that seems to be a pretty common sentiment that Lululemon has a stronger men's selection than maybe some of their competitors.
It's so interesting you brought that up, because to prepare for this interview, of course, right, like read the last few quarters of earnings, but also went to their website, and it talked about Father's Day, and all the photos are of women. And so it like, to me, if something that's kind of that basic is that big of a miss, I just think it says so much about so many things for them. You know, I look at kind of, right, like the signal to noise, if you will, but I will say that when we've done research at Coresight on, right, like how men are dressing for work and how they're dressing for the weekend, right, like Lulu and Biore are usually in those top 3. And so if they could really, I think, speak more to that male customer, right, okay, so you're wearing our pants to work, right, what are you wearing to the gym, right, what do you wear, right, like there's such huge potential there. And I feel scratching the surface in a lot of areas, but they're not going down a few levels. So that, to me, like, I think that speaks to who Heidi is, where her strengths are, and so I'm optimistic about her joining. But as Romain said, it just does feel like it's like a lifetime away.
Absolutely, a lot can change in the next 3 months or so. Deborah, great to break down these results with you as we see Lulu shares now down 9% after hours. That is Deborah Weinswig. She is founder and CEO over at Coresight Research. Now, coming up, we're going to talk more about the consumer and spending at large as we await tomorrow's jobs report. Yelena Shulyatyeva, she is senior U.S. economist over at the Conference Board. She joins us next. This is The Close. Well, we're keeping a close eye on shares of Lululemon, down about 9%. Just the latest glimpse into the state of U.S. consumer spending. Another key data point coming tomorrow in the form of the May jobs report, which Bloomberg Economics expects to show a solid increase. Joining us live is Yelena Shulyatyeva. She is senior U.S. economist over at the Conference Board. Yelena, great to have you with us. And, you know, you think about tomorrow's jobs print. I was having this conversation with Stuart Paul over at Bloomberg Economics that you think about where the hiring has been in this economy. It's been very narrow. It's been just a couple of sectors, healthcare among them. And the read-through, in his view, into the broader economy is that maybe you're going to see that sort of restrained spending, even if on a headline number, the jobs added looks pretty strong. And I wonder if that's a theory that you agree with.
I totally agree with Stuart, actually. That's what you see in the economy, a very narrow set of industries where we do see some hiring happening. So the economy is driven by AI investment, by data center investment right now, and not so much by the consumer. So because of that, there are some industries that are hiring and some industries that are not. So think about construction, think about, healthcare, which is a long-term structural thing, but also, industries such as logistics, freight. Those sectors may be hiring at the moment, but it's not broad enough. In order to have a broad-based hiring in the economy, you do need the consumer to participate, and that would involve a lot of industries that cater to consumers, such as retail, leisure, hospitality, and all those things. The labor market is okay. It remains solid. But I think we're on the same page with Bloomberg Economics on that one. It's the hiring is pretty narrow and limited to certain industries.
Well, if we follow that daisy chain down, you think about really narrow, labor market gains, potentially restraining spending. Does that cycle back to inflation? Could that have a sort of restraining effect on inflation as well if we don't see necessarily the pickup in spending that you might expect to accompany the labor market in this state?
Well, the conference board released two very important surveys last week. One was the consumer confidence indicator that everybody's familiar with. And we did ask consumers a special question about their spending patterns in this environment of high inflation. And 2/3 of the consumers actually told us that they're cutting back on spending because of high inflation. And those who are cutting back, they are actually planning to economize on things like toys, clothing and footwear. You know, I heard your conversation earlier. And also things like hobby-related stuff, so hobby-related goods. So that is an interesting thing. So overall, consumers are spending on necessities, but probably not necessarily on discretionary items.
And we've heard this particularly coming off of some of the conference calls of some of these consumer-facing companies with Five Below, Dollar General, Walmart, a few others, even Macy's, which actually had a beat and a raised quarter. They talked about this idea how people are buying the things that are really intriguing, meaning things that are unique, things that sort of offer them maybe, I guess, a little bit of slice of life. But beyond that, they're not. And I do wonder, and this ties back to the labor market, that when you see all of this money being pumped into AI with regards to the CapEx commitments, what are now hundreds of billions of dollars, we're going to be talking about potentially in a week another $1 trillion company being added to the financial markets. And yet we're not seeing job growth that's even anywhere commensurate with the increase in this sort of paper wealth. And I do wonder, is that just sort of an anomaly and a gap that will close naturally on its own, or something that, for you as an economist, you're a little bit more worried about?
I am worried about the lack of diversification in terms of GDP growth. It's good, you know, the economy is growing. It doesn't matter where growth comes from, right? Whether it's investment or consumer. But when it's narrow, the economy is vulnerable to external shocks. And we are going through one of them right now as we speak. So with the, the war in the Middle East. I think that companies are feeling like we do need to invest. We don't want to miss the opportunity. And if we can do that, we are going to. And that's why we see all this growth in investment in data center related investment. I mentioned the other survey that we released the results of last week. What was interesting in that survey is that the low fire environment still holds, but companies are starting to say that they may increase layoffs in the next 12 months. So that's a concern, and that's the shock that I'm talking about, that the economy is vulnerable to.
All right, Yelena, I have to leave it there. Great stuff. Yelena Shulyatyeva, senior U.S. economist over at the conference board. Just a reminder, 8:30 a.m. Eastern Time, Team Surveillance will have coverage of the release of the monthly payrolls report. The expectation, based on the Bloomberg terminal, is for creation of about 87,000 jobs. And more importantly, that 3-month rolling average is expected to actually increase largely because of hiring in the hospitality space. When we come back, we turn back to the IPO space. We got a new one today, and we're going to talk to the CEO when we come back after the break, right here on Bloomberg.
Shares of the Honeywell-backed firm Quantinuum closing out its first day just above its IPO price, erasing what was at one point a 19% gain. Now the company positioning itself as an engine of the advanced computing needed to support AI. Joining us live, I'm pleased to say we have Raj Hazra. He is president, CEO, and director over at Quantinuum. Raj, great to have you with us. Sure, it's a busy day for you. Tell us first, why this moment for Quantinuum? Why go public now?
Thank you for having me. It's a pleasure to be here. As we look at the computing space, we stand at a transformational time as workloads like AI have an insatiable need for computing resources, and at the same time, some of the classical computing approaches starting to show some serious sustainability issues around space, power. This is a perfect time to bring in a new form of compute that can solve some of those unsolvable challenges by today's means and do them. For us at Quantinuum, we've been at this for over a decade, previously as Honeywell Quantum Solutions and Cambridge Quantum, and since 2021 as Quantinuum, perfecting a full stack, building hardware, coordinated and co-developed software and solutions. And where we stand today is beyond the age of discovery, at a place we are accelerating our roadmaps, accelerating it through engineering and scaling, and building commercial solutions for our customers today. This was the right time for the sector. This was the right time for us as a company to become public, to become visible and accountable, and bring those solutions to marketplace and enjoy the next phase of our journey with our public investors.
Let's talk about that next phase, because as you mentioned, as a company, you've been at this for over a decade now, and certainly the quantum landscape has changed drastically in that time, and especially just in the past couple of years or so. So how do you plan to invest and use the proceeds of today's public offering?
The public offering proceeds are going to go right to where our strategy and executing our strategies to continue to feed our research and development into our roadmap, our hardware roadmap, drive software innovations, expand our commercial footprint, working with customers in different end markets and critical use cases that transform their business, and creating sustainable value, durable and sustainable value going long term.
I'm curious, Raj, here, when we start to talk about what the actual market is for quantum, and I know we're still kind of in a development phase and it's going to be some time, we get that. But at some point, obviously, particularly as a public company, there is going to be a lot of discussion by investors as to what the long-term proposition is. Where is the use case, or where do you anticipate that use case for these services being once we actually get there?
That's a great question. It's not a use case, because we've been engaged in customers across end markets, from pharma to materials to chemicals to financial services, transportation. We're seeing use cases, or really applications, of quantum computing, particularly when married with AI, transforming the way discovery is done. For instance, how molecules are sourced and created, and how very large data sets are analyzed for structures and behaviors, on how new sources of energy are tapped with the use of computing to identify the right chemistry to create them, fertilizers, you name it. So this is a broad-based transformation through a new form of compute in our end markets, which is broad and diverse. And so it's really not a use case, a single use case. We are seeing rapid interest, adoption, and particularly advancement of these transformational applications in the way discovery is done in all of these end markets.
What is the cost? And I am curious, because we've spoken with some other folks in this space, and one of the issues right now, currently, with regards to this technology, is that it's certainly costly to use, to utilize. How does that cost proposition potentially come down and make this more economical for your potential clients?
Yeah, there are two things that happen. Great question. One is, obviously, the technology as it matures, there's volume economics that come in. But perhaps more importantly is the value it creates. If you look at the use of quantum computing, for instance, to cut down the drug discovery time by 30 to 40%, or even 20 to 30% in a 20-year patent cycle, that's billions of dollars on a single drug. So if you look at the value of these systems, that generates these transformational, value creation, if you will, then the opportunity is significant, along with the fact that, of course, as technology matures and volumes increase, there's volume economics that drive costs down.
All right, Raj, appreciate you joining us here. Congratulations on closing out the books here on the IPO, and obviously the real work is up ahead. Raj Hazra, President, Chief Executive Officer, and Director over at the quantum computing company Quantinuum, which sold shares last night at $60 a share. It opened today at 68 and closed the day right at 60. 38. And of course, part of my last question has to do with this idea of sort of what the longer term addressable market is, because after all, that has been the main driver for the boom that we've seen in the AI space. One of the big beneficiaries of that has been Ciena, at least until today. The shares sold off dramatically, down about 13%, the worst day since early 2025, largely because of concerns about its full year revenue forecast. It was higher than what people had expected, but not high enough. And that's raising the question here, longer term, about the multiples people are buying into. I had a chance to catch up with the CEO, Gary Smith, who, in a very interesting coincidence, was actually at the helm all the way back in the day of the big telecom and dot-com boom and bust back in the late 90s and early 2000s. He became CEO of Ciena in 2001 after shares at that company effectively collapsed. They're back in the green in a big way over the past few weeks, over the past few months, because everyone thinks it will be one of the primary beneficiaries of the AI build-out. Here's what he had to say.
Companies like Ciena is adopting AI. We're seeing tremendous productivity gains in our services business and in our ability to get product out quickly. So that will begin to translate into economic benefits for the general enterprises as well as the hyperscalers.
Gary, do you have any concerns about some of the concentration risks with regards to your revenue sources right now? You said in the most recent quarter, basically about 34% of your revenue came from two companies. I know you don't name them, but anyone with the Bloomberg terminal can figure out pretty quickly who those two companies are. If they pull back in any sort of meaningful way from some of those CapEx commitments, what does that do to your forecast?
Well, I think from our point of view, it's not necessarily about the total CapEx that's spent, it's what are they spending it on. And increasingly, to my point, the constraint is around the network. So to enable all of the optimization of their investment, they really need the connectivity. And so, from our point of view, it's not about what, how much absolute CapEx, it's what they're spending it on and percentage of that for networking. And that continues to increase. And our exposure is across all of the major hyperscalers, neoscalers, and the large service providers around the world.
Just to wrap this up, though, Gary, and I'm just wondering if you could kind of just address less the issue of revenue growth and the growth of the company overall, and more importantly, the idea of maybe potentially expanding margins. That expansion has been relatively flat. And I understand there are some cost inputs and price inputs that are sort of factoring into that are beyond your control. But does this become more of a profitability and margin expansion story longer term, if at all?
Absolutely. And you're seeing a 4 times increase in our profitability year on year so far. And we think there's an enormous amount of operating leverage that we have in this business. We've demonstrated it over the last 18 months. We have an enormous backlog that we're confident will ship out in 2027 and beyond.
And that was the CEO and president of Ciena, Gary Smith. And, I was really eager to talk to him, on the heels of their earnings, because, this company was at the forefront of the big telecom.com boom back in the days. They make the optical, switchers or whatever. It's like, kind of like Cisco. But it's bigger. And they're kind of back in vogue again right now, Katie. Yeah. I'm told we have to go. Do you want to hear more about optical fiber and glass and lasers?
I would listen if you want to tell me.
Okay, I think we have to do a market check, though. But Ciena had an awful day today.
Well, we have some big movers to the downside, too, in the after hours.
I'll talk to you about it in the break.
Lululemon down about 10%. DocuSign also falling about 4%, even though they did nudge higher their revenue outlook. You can see the shares taking a dive. This is The Close on Bloomberg.
All right, well, we are 1 week away from the kickoff of the World Cup. Retailers, brands really gearing up to try to cash in on all of the mania around it. And, of course, that includes Nike. It's not an official sponsor, but it is ripping up the script for its 2026 campaign, recruiting the biggest athletes, but also the celebrities like Kim Kardashian, A$AP Rocky, Travis Scott, all there to sort of promote all of the products and services that this company wants to be affiliated with as it builds out its international football business. I had a chance to catch up with the head of Nike's global football, Camilo Andrade, to talk about this year's strategy, the leadership under relatively new CEO Elliott Hill, and the company's international growth ambitions. Take a listen.
We feel proud that we have this roster of people that we've been working with for many years, communities. And our job is just to extract the best of that and make sure that we put it in a way where communities feel excited, feel seen, and so that we invite different people through different pathways. And that's, in a way, what we're going to try to do this summer, is making sure that everyone feels represented and everyone feels that there's something for them so that they can celebrate football or the culture around it.
When we talk about the culture around it, and more importantly, trying to define that culture, and forgive me, I'm going to bring up one of your main competitors. Obviously, Adidas is the official world sponsor of the World Cup. It's the 3 stripes, of course, on that ball. But Nike has had sort of a reputation, even when they aren't the official sponsor of something, whether it's the World Cup or the Olympics, of always making sure that everyone knows that that swoosh is there. I think back to the '84 Olympics in LA, of course, '96 in Atlanta, and Michael Johnson's golden shoes. Yeah. You're on the outside looking in, and I do wonder, is it more advantageous to be on the outside rather than sort of inside the stadium?
I wouldn't say it's advantageous. I think for us, what is really important is that we are at the heart of the game, right? For us, it all starts with athletes, and we have the best roster of athletes that are going to represent their country in this moment. And our number one job is to make sure that we serve those athletes with the best of the best, so we can either reduce distractions or just enhance their tremendous potential. So that's number one. And then, of course, we have an amazing roster of partners through the federations, and therefore we are part of it in that regard. So I think for us, it's really important is that we think on how we show up in this moment and elevate the best of the game, because this is what we live for. We live to make the sport better. Yeah. So I think that we are in a very advantageous position ourselves. We look at what we have and what we do with it, the stories we tell, the partnerships, and how we continue to push further with every single one of them. And I think that you'll see that reflected through the summer, from the boots to, of course, the federation kits, to the collaborations, to everything around it, whether it's how we prepare athletes through a lens of training into how we help them recover. So I think we always craft our approach not around the things we have, but really around the things that we need to deliver in order to push the sport forward.
You put a lot of time and effort into this, a lot of money, I assume, as well, with regards to this marketing push. This is already a multi-billion-dollar business, football, for Nike. How do you measure whether what you're going to do over these next few weeks around the World Cup is a success, that you've actually done what you set out to do?
Yeah. Well, listen, internally, of course, we are looking at this investments across the board, and we are really thoughtfully measuring every single aspect of our efforts, whether it's innovation resonating with the players first and foremost, and they're, of course, engaging with communities, with consumers, the reaction. But the reality is that this is not just about how we win in the moment and how the investments in a way pay off in the moment, but really this is a really intentional investment towards our future, because this is not just about the moment, but it's about how we continue to lead in the sport, but also across all sports, because this is the play we've made last year is really going back to vertically being authentically rooted in every single sport, obsessing every detail, sustaining that effort, not just being in the moment, but sustaining it, and then making sure we connect the dots when possible. And I do think that that's the beauty of football, is it allows us to connect the best of our sport-led offense in a moment and really create, in a way, exponential compounding momentum.
I am curious about some of the changes that Elliott Hill has made. I mean, you were with the company before he got there. The company was structured a little bit more around, men's, women's, et cetera. Yeah. He came in, ripped that script up, said, we're focusing on the athlete. This is about sport. So you've been a part of both strategies, and I'm curious as to how the strategy that Elliott Hill has now taken this company on differs from what you were doing before. Did it really require you to change what you do and how you thought about it?
Yeah, it's a big shift, right? At the end, it's a big company, but the good news is that the fundamentals were always there. I think that's what he's been amazing, is that he, in a way, allows us to refocus on the fundamentals that made Nike great. So having experienced it before and now, what I could say is that we've taken the best of the best, but in this new offense, it allows us to have more depth and breadth in the way that we authentically serve athletes in every sport, while never losing the ability to look across and connect what's best of our portfolio of the sport offense. So it feels different in the sense that now we have a renewed focus across the end-to-end value chain of Nike, and it allows us to really obsess every single aspect to it, but with the scale that Nike can provide in serving consumers. So
I am curious just geographically in terms of who you appeal to. I mean, obviously this is a global sport. The U.S. has obviously become a big market for international football. We're hosting it in 3 countries this year. I think in 4 years, it's going to be in a few different countries, including Morocco and a couple others, I'm forgetting, basically North Africa. And then after that in Saudi Arabia. We're now entering new markets where the World Cup traditionally hasn't always had a stronghold. how does that change your marketing approach? And more importantly, what does that mean potentially for growth or maybe the broadening of your revenue and your customer base?
Yeah, listen, there's no doubt for us, that's why this moment matters a lot, is there's tremendous opportunity here, but football is the biggest global game, right? That's why we got into football, so that we can leverage the scale of the sport and in a way appeal to more consumers. Of course, we see opportunity everywhere, and that's the beauty of this game, is that we can grow everywhere. But our approach is always a combination of making sure that our point of view globally it's really clear, and that through that point of view, we really anchor on what makes Nike football unique. And then we can create layers of dimension where you can bring the flavor of every single region, every country, every city, because football is not experienced the same in my country, in Colombia, as it is experienced in Asia. So we want to make sure that we create opportunities to, in a way, show those different edges of the sport and those different dimensions.
Do you think we'll see a bigger push by Nike, and I'm talking with regards to the international football business, more into Asia as well? I mean, obviously it has a stronghold in Europe, certainly a stronghold in Africa, and certainly Latin America. But what about Asia? I mean, I know China isn't in the tournament this year, but does that become a bit more of your focus as you look to the next couple of World Cups?
Yeah, it's always been important, and we have tremendously important relationships in China. For example, we have the China Super League, we have, of course, the national team. Our players are China actually unveiled the new Mercurial because of time zone, and we have tremendous reaction. So China is really important for us, and the potential there is massive. We're actually seeing tremendous momentum with what we're doing right now, and knowing that now the women have qualified for next year. So I think for us, we see tremendous opportunity on how we think about the women's side of the game and in Asia, and we're really having an opportunity to, of course, lean into that, but it's definitely a really exciting opportunity where we're continuing to invest as well.
Camilo, last question here, and I know you're not necessarily the one in charge of this, but I started this off talking about how you guys are kind of on the outside looking in. You recently poached Germany from Adidas. Those 3 stripes will be a swoosh after 2027. Adidas's contract with the World Cup runs out after the 2030 tournament. You think we're going to see a swoosh on that ball come 2034?
Listen, I cannot comment on that. What I can tell you is we're really excited about the future. We are making all the right moves to make sure that Nike continues to, in a way, serve consumers around the world. We're really excited about next year. Next year is going to be a tremendously important year as well for us as we continue to fuel this momentum that we're seeing. So yeah, I would say that stay tuned.
That was Camilo Andrade, Nike's Global Football Vice President. As they are on, Katie Greifeld, basically what is a 12-week marketing campaign around the World Cup. And I pointed it out in the interview, I mean, they're not actual official sponsors. They do address some of the national teams, including the U.S., France, Nigeria. So they will have a logo on some of their shirts. But obviously, when we talk about the formal stuff, it's still Adidas still kind of rules that roost. But those contracts are expiring. It'll be interesting to see whether Nike can make a push.
Yeah, absolutely. It seems like, that's behind this 12-week push, is trying to really set themselves up for the next decade of World Cups. It's going to be interesting to see how that shakes out, in addition to the games themselves, of course.
Yeah, and I know you're a big sports fan. I was watching Real Yield earlier, and we were talking about the Chicago Bears, and of course you got the New York Knickerbockers. Won their first game last night. I assume that's why you were off yesterday.
Big time, yeah.
And we might get a convergence. There might be like a finals, NBA Finals game on the same day as a big World Cup game.
I was going to say, I mean, you think about the tri-state area here, the New York metro region, the fact that the Knicks are in the finals and some of those games are coming to New York City themselves, it feels like maybe that's taking some of the excitement away from the World Cup.
Yeah. Well, I think I'm just going to go hang out in front of MSG on Monday and get some baklava and see what happens
Just
here.
a normal Monday.
Absolutely, as I do. We're going to set you up for what to watch when we come back after the break. This is Bloomberg. Let's set you up for what markets will have their eyes on over the next 24 hours. Katie, with earnings season more or less out of the way, all eyes back on the macro and in a big way at 8:30 a.m. tomorrow with the monthly U.S. jobs report.
Yeah, an interesting read on the state of the labor market, especially as some of the concern really shifts over to the inflation side. But also at 12 p.m., we're going to have Alphabet's annual general meeting. Alphabet, of course, making a big splash this week with their equity raise.
And speaking of general meetings, we should also point out that Netflix's annual meeting is set to kick off in about an hour's time, the end of an era for Reed Hastings, and the start of a new era here at Bloomberg Television. You take a look at the person there on the left. Scarlett Fu's got a new show called Bloomberg Money that apparently she had to bring Tom Keene along for the ride.
I am so excited about this. They're going to talk about how people are making and also spending their money.
I'm actually looking forward to this. Obviously, we love Tom Keene. That debuts tomorrow at 12 p.m. noon right here on Bloomberg.